Um, I'm Michael Kopinski. I'm the Director of Research at Noble Capital Markets, also the Media and Entertainment Analyst, and I'm pleased to introduce Cumulus Media. With me, we have Frank Bevel and Collins. So I would like to first start. I'm going to, this is a fireside chat format, but we'll take questions. If you have questions, just raise your hand as we're going through the presentation. So Frank, let's start with you. Big picture question, you joined the company a couple of years ago, and just as the pandemic was hitting, and during that time, obviously, a lot of things has happened. Can you walk us through how the company has performed during that time, and maybe if you could just talk a little bit about, how Cumulus managed through that process and what Cumulus is today?
Great. Well, thanks for having us here today. So, correct. I started in March of 2020. It was the third week of March. Interesting time to start at the company. And within a week of starting the company, I had to work with our CEO and the rest of management to furlough people because our revenues were being hit significantly by COVID. In fact, this is not something I would welcome to anyone, but my first quarter as a CFO of this company, revenues were down 47%. But since then, we've made a remarkable recovery from a business perspective. Let me describe what we've done. So our revenues for 2020 declined 25% for the entire year. The second quarter, which was my first quarter as a CFO, as I mentioned, we were down 47%. What we needed to do at that point was right-size the company from an expense perspective, and we made a lot of difficult decisions. So including furloughing the company, reducing compensation, and reducing our workforce, which was a difficult decision to do, but something that we needed to do. But having said that, just put it into perspective, in 2020, notwithstanding the decline in revenues, we still generated positive cash from operations. We had the benefit of monetizing a couple of non-core asset sales. And believe it or not, in that environment, our debt was almost down 30% in 2020. So to give you a sense of the trajectory, 2019, our EBITDA was roughly $215 million. In 2019. In 2020, it was $82 million. Last year, it was $135 million. And then on our most recent earnings call in February, I've guided the street to $175 to $200 million. So that's a huge recovery in our business. Not only that, our liquidity on our deleveraging profile has been, in my view, nothing short of spectacular. Our peak leverage was north of 11 times during COVID. We ended 2020 leverage of just under 9 times. We ended last year in December 4.7 times. And I indicated in our last earnings call that we have a new net leverage target to be below 3.5 times, and we will hit that by the end of the year. So when you think about a 2-year horizon where you've gone through a pandemic, we've taken out a lot of fixed costs of the business, and in fact, $75 million of fixed costs in the business. 2 years later, we're sitting here with 40% less debt, an improved operating model in terms of operating leverage, and really in the best position, frankly, in the industry from a balance sheet perspective. It was hard, wasn't necessarily fun, but we're stronger for it.
For sure. I mean, what an introduction to the company, right? Have all those things thrown at you. Right. Of course, now we have a couple of other hot spots, right? We have inflation, and of course, we have the Russian-Ukraine war. How is that impacting advertising at this point?
Well, the Russia-Ukraine war, I mean, we're a domestic business, so at this point, our hearts go out to the conflict around the world, but it's really not impacting our business at this point. Inflation is something that we have to look at. We've taken a lot of fixed costs out of the business, but there are parts of our business that have inflation in it, and we have to monitor that closely. I think as we get to the second half of the year, as the Fed continues to signal that they're going to increase rates to combat inflation, they will have to look at whether or not that will result in an economic slowdown. and that would impact advertising. Having said that, based on the trends in the first quarter, and I'll be able to talk more about our trends when we announce earnings in a couple of weeks, that things so far feel pretty good. But obviously, we'd like to have a lower inflation environment and not be in a situation where the Fed tries to engineer a hard landing.
Well, and you're in a much stronger financial position than you have been, through any time in your past, and so we can talk a little bit about that in a little bit. Let's talk a little bit about you recently signed a new agreement with the NFL. How does that new agreement impact Cumulus's growth? Can you talk a little bit about that?
Sure. Well, we've had the NFL in our stable for decades at this point, and so this is an extension of that transaction. We're delighted with a partnership with the NFL, and we're able to extend it. What's different about this transaction or this partnership compared to last renewal is that we have all the digital rights, audio digital rights. And that's extremely important because as we've talked about our growth engines of the business, which is not only the terrestrial radio recovery, but our digital growth, having digital rights to the premier sports league in the U.S. is something that we're going to be able to monetize across all of our platforms. And so it's key to our strategy. We have two of the largest sports contracts in audio with the NCAA, which last year we extended that contract, and the NFL. And that sets us up very well from a program perspective and offering different channels to our advertising clients.
And one of the things that I'm going to circle back to the pandemic, there's one of the things about radio is that it has had pretty stable listenership, and I was just wondering if you could just talk about the listenership through the pandemic and what you're seeing now. Do you expect that it's going to come back to some sort of normalcy? What are your thoughts about listenership?
Okay. I'll have Colin address that.
Yeah, sure. I'll take that. Thanks again, Mike, for having us. So as we think about the listenership trends since we've come back from the pandemic, obviously we saw during the pandemic quite what you would expect with fewer people driving. We saw a lot of that drive time listenership dry up. One thing that we saw that was really interesting during that time frame was we saw a spike in streaming listenership, right? So people were seeking out the content that they were very comfortable with, that they liked listening to during the day, and they were just translating that back, listening in the home, listening on smart speakers, listening on their computers and on their phones. And so as we've seen the recovery come back, we've really seen the number of people listening to radio essentially get back to where it was before. 91, 92, 93% of America listens to radio every single week. That was true 20 years ago. That's true today, other than for a short time frame during the pandemic. We have seen some impact on time spent listening, and that varies based upon market size in terms of what you would expect. Where there's been more permanent work from home, you've seen a greater impact. Where there's been less permanent work from home, you've seen a lesser impact. But the way that we're increasingly thinking about our business is not just about those over-the-air trends, and as much about how much of the share of audio listenership can we capture? How can we take that streaming spike that we saw during the pandemic and maintain that? How can we increase the amount of content we push out through podcasts and increase listenership there? Because at the end of the day, what we're trying to do is maximize the amount of audio impressions that we have available to take to market, and then go sell those audio impressions. And so to a certain extent, we are somewhat indifferent between whether we're generating those impressions over the air, whether we're generating on the stream, whether we're generating them through podcasts. There are slightly different margin dynamics in each one of those channels, but ultimately that's how we're going to reach the consumer over time.
And Frank, you were talking a little bit about how strong the bounce back has been, and you gave guidance in terms of pretty favorable cash flow growth. Can you just talk a little bit about what is the sense of the drivers that's affecting that comeback and that performance, and maybe just talk a little bit about maybe advertising categories or geographics? What is really the key drivers?
Mm-hmm. So when you think about the different categories, we have categories like professional services, home services, financials, which they were pacing at or above 2019 levels. So it's a recovery from the weakness. We also have new categories that we didn't have back in 2019, or they were nascent, which is sports betting, and that's been a growth category in a lot of companies in our space are talking about that, but that is a huge growth and new revenue stream for us. Having said that, we are still seeing knock-on effects in terms of labor shortages and supply shortages. So, for example, one of our larger categories, which is auto, is still well below the 2019 level and still challenged versus last year. So when you blend it all in together, when you have the categories are returning on one hand, and then you have our digital growth, which last year our digital businesses grew 47% for the entire, or 48% for the entire year. You have a legacy radio business which is still recovering, some parts close to or above 2019, a growing digital portfolio, and that results in the general growth of our business. So I did mention that on our last earnings calls we were pacing as a company up in the low teens, which is a really robust growth versus last year, and continue to be fairly optimistic.
Can you expand a little bit on the sports betting, because you had a deal with WynnBET, and I was just wondering if you can talk a little bit about that and how that is unwound, and then how you're seeing that category being replaced. I mean, how that replace it with the deal you had with WynnBET.
Sure. So last year we did ink a long-term partnership with WynnBET or Wynn Interactive, and this was as they were ramping up their spend to be more competitive in the sports betting space. And that was a deal that we talked about in our third quarter earnings call in August of last year. The transaction was not contingent on a SPAC being closed, but if you followed the news on WynnBET, they had announced a SPAC merger, and if it closed, it would have resulted in them receiving a lot of money, a tremendous amount of money to advance their marketing needs. That SPAC deal fell apart and did not close. They reassessed their spending in the space, and they came back to us to look for a way to restructure or terminate that relationship. So as good partners, we looked at what the commitments were, what our remaining inventory was throughout this period of time, what we could replace. And I did mention the first quarter that we came up with a termination with that long-term agreement, which resulted in a settlement payment, which I'll talk about more in a couple of weeks. So we were disappointed to see that partnership end. But having said that, the space is still a very large space. Last year we had 20 different sports betting advertisers. It's a space that continues to be fairly robust. But then we're looking at new and different categories, which are nascent categories. So one of the main focuses now is the whole crypto space. As you've seen a lot of advertising on television in crypto, you've seen certain companies spend a bit of money for naming rights for sports arena. And it's a natural extension, we believe, that to attract attention and for retail buyers to come to radio, much in the same way we set up this agreement with WynnBET to create a multi-platform, multi-market partnership. So that's going to be an area that we're going to be focusing on, in addition to what we think is a fairly robust sports betting opportunity for us.
And earlier you were talking about your digital businesses. You know, they were up 48% in 2021, and I was just wondering if you could talk a little bit about all the key components of your digital businesses and the growth drivers there.
Okay. So last year our digital revenues were about 14% of total company revenues, or about a little bit over $125 million. And the way to think about it, there are three key components of our digital businesses. First is the streaming component. So if you're listening to our multicast with an earbud or through your home device, we can capture that listenership, and that's a component of our digital revenues. The second component is our digital marketing services business, which we call C-Suite. And what that business is we leverage off of our sellers in the local markets, not only to sell them campaigns for radio ads, but to be their one-stop shop for their digital marketing services need. And that's a big market when you think about companies in the U.S. Have less than 50 employees. We think that TAM of that space is about a $15 billion TAM in the U.S. Now, of course, we're not in the entire U.S., but that's a business that's growing nicely. It's a complement to what our sellers do. Then the third component of our digital business is our podcasting business, which is one of the top 5 podcasters. We are one of the top 5 podcasters. We're well known for some of our conservative talent on podcasting, Ben Shapiro, Dan Bongino, Mark Levin, to name a few. And that business has grown very, very nicely. They represent roughly a third. Podcasting is a little bit bigger than the other two given its growth. Looking at 2022 last year our growth was aided by the reclassification of some of our digital stream revenues which we had booked in our spot business, but now that we're able to measure the digital streams, we move that into our digital bucket. So had we not reclassified those revenues, digital would have still would have been up in the mid-20s. So I mentioned that because the 48% growth did benefit from some reclassification of revenues in the balance sheet. And this year we'll have a fair comp in terms of apples to apples.
Gotcha. And you're just to drill down a little bit in your podcasting business, obviously one of your fastest growing segments. Obviously, we've seen a lot of other competition emerge in this space, and I was just wondering if you could just talk about the competition, how you're faring against the competition, and what you think the growth trajectory might be.
You take that, Colin.
Sure. As Frank mentioned earlier, we have a top 5 podcast business, and the way that we actually approach podcasting is a bit different than what we see a lot of our competitors do. You have some in the space that are focused on the consumer distribution side of the podcast game. That, to us, is not the area of the ecosystem that we think that we will add the most value. Today, people want to listen to a podcast. They can get those podcasts anywhere. And we encourage that. We want them to be able to get those podcasts anywhere. Where we really focus is on being sort of an ad network, so to speak, being the best monetization partner. And it's in our DNA to be able to do that and do that well. If you think about who's buying these major podcasts at scale, it's the national, regional, direct-to-consumer, and brand advertisers that for decades have been buying network and national radio. So we have relationships with all of those advertisers. We have relationships with all of those agencies. So it's a very natural sell for us to be able to bring that value proposition to market. We do work with our content partners across the spectrum. There are some where we are simply an ad sales rep agent for them. There are some where we do promotion. There are some where we do production alongside that as well. And those deals vary based upon what makes the most sense for that individual talent. But collectively, our platform did over 1 billion downloads last year, and that puts us squarely in the top 5. There's another aspect of the podcast business I just want to mention quickly because I think it's also interesting and unique for us to also have the owned and operated radio group, is we have added a material number of local podcasts over the course of the last year, utilizing the best practices that we've identified on the national side and really being able to push those down to the talent. And the nice part about that is we tend to have different economics at that level. So we launched hundreds of new local podcasts. Some will work, some will not work. We'll iterate on that as time goes on. But it really speaks to the whole audio-first, multi-dimensional strategy of wherever there is talent that we have a relationship with, we want to be able to have a relationship with them across the multiple different forms of audio distribution they can have. And we've even done that on the podcast side nationally. We're the only group that has successfully taken podcast native talent and then put them into broadcast radio syndication. And we've now done that twice to great success. Both Ben Shapiro and Dan Bongino have 200 plus radio station affiliates for their bespoke radio shows that they're creating alongside their podcasts. And so that's been very successful.
I want to turn back to a little bit about the advertising. I've been in this business long enough to know that we've had attrition in advertisers and categories emerge and categories fall. And so it's typical cycle of radio and the emergence of new industries and so forth. And of course, right now earlier we talked about sports betting and that sort of thing. I was just wondering if there are other advertising categories that are on the horizon that you see that might emerge to become, a pretty significant player in the space.
Well, what's interesting is that the efficacy of radio advertising is amazing because of the reach that we have and also the price. And we've seen examples in the past, and P&G's talked about it as an example, where they've shifted some spend, which has been traditional TV or other media, to audio because of the efficacy in the hyperlocal area. And I do think as we go through this year and next, there's going to be an entire revisiting in terms of the ROI in advertising. And so, for example, pharma is an area that's growing for us. That's an area, of course, if you watch television, we see there are pharma commercials everywhere, and we're seeing that as an example of a consumer-facing type of branding experience that's moving more towards radio. I'm sure there are going to be different categories that we'll speak about in 2 or 3 years from now, which we didn't anticipate. But what we continue to focus on are for those advertisers who are spending a lot of money to get their name and their brand out in a broad reach in a very efficient way, battling not only the marketing wars, but explaining why the return on investment is compelling. And that has worked over the past several years, and we'll continue to see that.
And Frank, earlier you reaffirmed your guidance that you talked about 175 to 200 million in the EBITDA. Was wondering, and you also in a previous call indicated that the first half is going to be harder. And I was just wondering if you can provide some additional commentary, what your thoughts are about that.
Obviously, there'll be more I can talk about in a couple of weeks when I do earnings. But what I did say on the earnings call is the upper half of the range would be harder to reach versus the lower half of that range. Yeah, as opposed to calendar year. And the reason we said that at the time was we knew that we had a headwind with the WinBet transaction unwinding, which we would have expected otherwise more revenues. And we knew we had a headwind with auto, which continues to be slow. And so, but we're comfortable within the guidance, and all I can say is we'll have it, just listen to our earnings call in a couple of weeks and be able to give you more perspective then. Gotcha.
And obviously we're expecting a strong political year. Have you given us any expectations about political in 2022?
What I'll say about political is that in the last off-presidential cycle year, so that was 4 years ago, our total political revenues were in the range of $20 million. Presidential election, we had political revenues of $26 million, but that was also, we had a benefit of the Georgia state runoff. So were not for that Senate runoff, it would have been a little bit lower. So for planning purposes, given what we all see, which will be a competitive market, we have no reason to believe that it should be less than what we had 4 years ago.
Mm-hmm. And you indicated that your plan is to get leverage down to 3.5 times. And I remember, going back in the 80s when I was following the industry, that was kind of like the target range. I dated myself just there, but I remember that had been the target range of 3.5 times. And so why do you think that 3.5 is the right target?
Well, for several reasons. We had, coming out of the restructuring, we indicated we wanted to get to below 4 times leverage. One of the things that we all learned through the pandemic is having financial flexibility is so strategic and so important with downturns. Now, we had the benefit of working through non-core asset sales through the pandemic, which certainly helped us reduce the leverage in addition to the cost cuts that we went through. But we think having a lower net leverage target, and I'll repeat, we will be there, our expectation will be below that by the end of the year, gives us not only financial flexibility in the future for the next downturn, whenever there is, but we also think it's helpful for the equity by reducing the equity risk premium of the business. When I joined back in 2 years ago, and EBITDA was declining, our stocks, many highly leveraged stocks were pummeled because of the perception of, is there too much financial risk in the uncertainty? So having less leverage gives us flexibility, and we think ultimately reduces the risk premium for the equity and should accrue to the equity benefit.
Yeah, you have been telecasting to the to investors that you're in a position to have a return of capital in some form, and do we now have to see the 3.5 times debt to get to that prospect, or can you give us some thoughts about what you're currently thinking?
The answer is not necessarily. When we look at our models and we believe and expect to be below 3.5 times, a lot of the decision is where we are on that ramp to deleveraging. And so I would say that it's not a bright line that you need to get to that level and it's a go. So that's why it's not necessarily. It's something that, from a return of capital, we actively speak to the board in terms of our plans and projections, and we'll see. We'll see the timing of that this year.
I'm going to kind of go through a couple of other quick questions because
Sure.
we're going to be running out of time here. In terms of your capital structure today, can you just talk a little bit about fixed versus floating and what your thoughts are there?
Mm-hmm. So at the end of last year, we had approximately $805 million of funded debt. $445 million of fixed rate debt through bonds, and the balance of their term loan. And we've set, and against cash of $177 million at the end of the year. So our net debt was approximately $625 million at the end of the year. We do have, our term loan has a 1% LIBOR floor. So we, in essence, and it has a spread of 375 basis points. So we've, in essence, been paying 4.75%, even though it's a floating rate debt. We're cognizant of rates rising, but as we look to reduce debt, from a cash flow perspective, the absolute reduction of debt we expect will more than offset the potential increase in short-term rates.
Okay. And can you talk a little bit about capital allocation with your free cash flow at this point between M&A, dividends, buybacks?
Well, the whole return of capital discussion is something that we've focused on. As we set our leverage targets to be below 3.5 times, we did it in a very holistic fashion. We looked at what's the right net leverage to get to from our perspective, what flexibility do we have to make accretive and strategic acquisitions, and then lastly, what is the form, when and if, of the return of capital. On the form of it, it's something that I would say we'll discuss with the board and really can't talk about when it will occur and how will it occur, but it's something that we're focused on closely. We do think, though, when we made the statement that being in a position to reduce debt to below 3.5 times net leverage and be in the position to return capital to shareholders, we did that with the mindset of still maintaining flexibility to do acquisitions if they're accretive and made sense. So we try to take, as I mentioned earlier, a holistic view.
Right. I know the elephant in the room is that, and I'm just going to mention it because I doubt that you're going to be able to comment about it, but getting a takeover indication at a certain price that seems well below what my target price is. I'm sure, I don't know if you have any comments about that, but if you would like to comment about it, that's great. But I'll just indicate again that it was, the indication at least seems to be well below what my price target is. But I'll leave it open to you.
So there was an article last week that came out, and we put out a statement that we did receive an unsolicited, highly conditional letter of interest, and that the board will, with the financial advisors and legal advisors, review it. If you believe what you read in the article in terms of a price, yes, factually, based on that article, it's quite a bit lower than your price target. But it's going to be for the board to review and decide, and more to come on that.
Okay. Are there any other questions? Go ahead.
If you were to pursue the acquisitions, what would you like to build out?
Yeah, sure, I'll take that. Really would put it in two buckets. So the first is what we've referred to historically as portfolio optimization, and that is steady state. We have 406 radio stations across 86 markets. There may be opportunities for us to get bigger where there's a path to a leadership position. There may be opportunities for us to get smaller where there isn't a path to a leadership position. We've done a number of transactions like that. In particular, we did a handful of swaps in 2019. And when you can find those transactions, they really work out well. So we're very disciplined. We're very disciplined buyers. We're very disciplined sellers in that space. But that's one area that will just always have a steady hum of focus. And then the other area would be any businesses that can help facilitate and put more fuel on the fire of the digital growth that we're seeing. One thing worth noting as we've thought about the cash that we've generated from operations and the debt pay down that we've seen and the net leverage reduction over time, at every instance we were also very actively looking in the M&A market for potential opportunities. There are very few deals that you would read about that we didn't look at or have an opportunity to look at. But we remain really focused on ensuring that we're allocating capital appropriately to the right opportunities to drive the best growth in relation to the other things that we can utilize for that cash. So if there were businesses that allowed us to put more fuel on the fire of our digital marketing services business, that would be interesting. We've looked at things in the podcast space. We've looked at things in the streaming ecosystem. So those will be our key areas of focus.
And with that, that's the end of the time that we have. Thank you.
Thank you.
Thank you, Mike.